Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money and your host for this session. Welcome to another episode in our series where we unravel the complex financial world and its intricacies and bring insights that may elevate your financial understanding and contribute to your overall financial well-being. Today's episode is brought to you in association with ICICI Prudential Asset Management Company Limited, and our topic for discussion is Smart Beta ETFs. Though we covered Smart Beta ETFs in an episode a few months ago, but considering the continued interest among our listeners for further discussion on the topic, we are pleased to present another episode on the topic. Investors seeking to minimize risk may opt for passive mutual funds, which track the performance of an index. One such category of passive investment is a Smart Beta ETF, which is relatively new in India and may not be widely known among small retail investors. In today's episode, we aim to delve deeper into these ETFs and explore their intricacies. Joining us to shed light on this topic is Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. Let's begin the session now. Welcome, Mr. Haria, to this episode.
Thank you, Versha, and thank you to all the listeners of Outlook as always. Thank you for taking the topic as well. Like you rightly said, this is a topic of interest and it's a topic which requires repeated inputs for the investors to understand it better. So thank you for taking it up. Over to you, Versha.
Okay. So, Mr. Haria, typically individuals may have some familiarity with ETFs, but Smart Beta ETFs might be a new concept for many. So to begin, could you demystify the term Smart Beta ETFs for our listeners?
If we look at from a fund management perspective, just on the basics, there are active funds and passive funds. Active funds, which are more popular and have been in India as investments by investors for a long period of time. These are funds wherein the fund manager takes the decision of which sector, which stock, what is the proportion, based on obviously the scheme investment document and the objectives of the particular fund being managed. On the passive side, which is getting more and more popular recently in India, there are index funds and ETFs. Both index funds and ETFs follow a particular defined benchmark index. Both index funds and ETFs would have the stocks, the sectors, and the weights as given or as available on the benchmark index itself. So there is no involvement of an active fund manager on the passive index funds and the ETFs. And this essentially makes them low cost as well. So in India, both active funds and passive funds are growing. And within passive funds, as the case may be, the popular ones were large cap passive funds. And then we had mid cap, small cap passive funds also come in. There were a lot of sectoral funds in India like banking, etc., which were very popular. However, of late, as you mentioned, the smart beta concept is becoming popular. Now, what is smart beta ETFs or smart beta funds? Smart beta, as the name suggests, is essentially a passive fund, a passive ETF or a passive index fund, which basically also mimics an index, but the constituents of an index are selected in a way that they are not only market cap based. Think of it when an active fund manager manages the fund, the active fund manager selects stocks either on the basis of valuation or on the basis of their momentum of the underlying stocks or on the basis of how stable those stocks are and creates a portfolio based on the style of the fund manager. It is with this background that the smart beta ETFs, the selection of the stocks is on the basis of one of the factors or multiple factors which otherwise are used generally by active fund managers to create a portfolio. So to an extent, the smart beta concept is an intermediary between active and passive, where the underlying stock selection is based on defined rules and the weightages is on the basis of the factor itself or a combination of factors. Just to elaborate, smart beta, for example, with which are popular in India, momentum, low vol are two popular smart beta concepts in India. There, if you have a defined universe, let's say a in the case of low vol, you have a universe of 100 stocks defined, which is the top 100 stocks. And within that universe, then you are to select 30 stocks which have the lowest volatility over a 6-month and 12-month period. So the factor here is essentially low volatility, which is a smart beta factor. Based on low volatility, the 30 stocks which are selected are essentially the smart beta which make up the low vol index. And within that, the weightages and the selection both are defined by low volatility. So you have a defined universe. From the defined universe of 100 stocks, you pick 30 stocks. After those 30 stocks, the factor which is important is low volatility. And then the weightages are also on the basis of how less volatile the stock is. This is the concept of smart beta, where the selection and the weightages are on the basis of a factor, or it can be on the basis of multiple factors as well. And like I mentioned, this is somewhere related to how an active fund manager does the stock selection. So it's an element of active selection of stocks in terms of the factor. And it is a passive fund because once the factor is decided and the benchmark is created with the rules and regulations, it is with the choice of this smart beta factor that the portfolio is created, and every 6 months or 3 months, the portfolio rebalancing happens. So that's the concept of smart beta ETFs. Thank you.
Thank you for giving an overall view on smart beta ETFs and covering most of my next question. But now let's break it down and take it one by one. So first tell me, as smart beta ETFs is a factor-based concept, and some of the popular ones are momentum, low volatility, alpha, and value. Are there more factor bases which new smart beta could be created on?
So there are as many factors and as many, so there can be price factors, there can be fundamental factors, and as we know, many technical, price, and fundamental factors exist. So you can have permutations, combinations of these multiple factors, and you can create multiple smart beta index funds and indices, which exists in the international market for sure. And if you look at from an international market standpoint, there is a lot of smart beta indices available as well. In India, the concept is only 5 to 6 years old, maybe 7 years old. And so, like you said, there are limited number of choices right now with India. There was a value index, then there was a low vol, then alpha low vol, momentum, quality. These are the basic ones which are available. But as we move forward, there will be many more combinations and factors which can be put together depending on the appetite and depending on the market condition. And based on what works in India, I'm sure the asset management companies would be launching funds for the benefit of the investors in the smart beta category. Thank you.
Okay. And is a combination of two or more factors advisable? What, according to you, should be a better strategy? Investment in one factor or two factor or even more?
Much like how market cycles work, factors also have their own cycles in terms of performance. Sometimes a low vol factor works very well, like it did in 2015 to 2020. Sometimes a momentum factor works very well, like it has done in 2021 to 2023. The objective is over longer periods of time. These factors, if selected properly, can tend to outperform the broader market indices, and which is what the objective is. The investors, of course, when they're creating their portfolio, can pick and choose either a factor or a combination of factors which basically suit their investment style. So if an investor has higher risk-taking ability, they would normally go for a momentum fund. If an investor is already invested in higher risk categories on the active side, then they may complement it with an alpha low vol or low vol ETF on the passive side. So it all depends on the overall portfolio construct of the investor. But yes, smart beta concepts, if chosen wisely and the proportion selected wisely, can add to the overall investor experience of the investor. And to that, whether it's a single factor ETF or it's a multiple factors in one ETF itself, or you choose a combination of ETFs which provide you differentiation in terms of factors, it totally depends on your risk profile. But yes, they do have a place in your overall portfolio, and we'd encourage investors to start taking smaller exposures to start with to understand them better. And then as their confidence grows, they can pick up, their investments in terms of their exposure to smart beta ETFs.
Okay. And your fund like ICICI Prudential Nifty 100 Low Vol 30 ETFs. This fund generated around 30% return in 1 year, and two factor ETF, which is ICICI Prudential Nifty Alpha Low Vol 30 ETF, it gave around 38%. So there is a difference in the return. So could you explain if low volatility ETFs are advisable in the current scenario? And if yes, then why?
If you look at the indices in question, right, in terms of risk and reward, if I have to stack them up, low vol because it is choosing stable stocks from a universe of 100 portfolio. So just the top 100 universe, you're choosing 30 stable stocks. It will have a certain risk and return profile which will be lower in a steady market condition relative to say an alpha low vol. Just to explain what an alpha low vol does, it gives 50% weight to alpha stocks, which is essentially those stocks which have beaten the benchmark over the last 6 months and 12 months. So it is picking stocks which have a certain level of momentum to it, giving it a 50% weight, and also those stocks which have shown low volatility of 50% weight. So alpha low vol is the universe is 150 stocks, so you're going towards the 50 mid cap stocks as well. And if you combine the two, alpha, of course, the parameter or the factor will have a certain higher risk for which the investors need to be rewarded in a certain higher manner. So if you take a risk and reward metric, low vol will stick at a lower level in terms of risk and reward. Alpha low vol, because it has an element of alpha or momentum, 50% weightage, would have a certain higher risk and reward. And if I have to extend this conversation to a momentum ETF, which probably could have also given slightly higher return than even the alpha low vol, in momentum, you have a 200 stock universe. Out of 200 stocks, you basically select 30 stocks which have shown momentum in 6 months and 12-month basis. And that potentially has the highest risk reward ratio. So in terms of risk and reward, low vol, alpha low vol, and momentum in that order generally would be the stacking order. Depending on investors' risk appetite, they can choose either or. There will be times where the market corrects and the risk can be played out. And there are times like last year where markets were doing well and the returns would also show up. So in the long run, of course, it is the investor's overall risk return profile, which should determine where they want to invest their money. As far as we are concerned, all three indices, be it low vol, alpha low vol, and momentum, have their defined universes, have their defined set of selection methodology as far as factors are concerned, and that gives them a defined risk and reward. And then investors should basically look at that risk and reward and fit the suitable fund in their portfolio for long-term wealth creation of theirs while keeping the risks in mind.
Okay, all these concepts, alpha, low vol, alpha, momentum, and all are there. But don't you think it's a little technical concept for the general public to understand and choose a suitable smart beta ETFs themselves? Is it a DIY product or it needs some hand-holding or advisory in case of small investors?
So as far as India is concerned, I believe even for basic investing, we need definite hand-holding. So much like how we have a family doctor for our illnesses and health issues, it is always advisable that if you don't understand finance, please take help of a person who takes or who is basically a financial advisor or understands finance. And that person, be it an IFA, RIA, whoever the advisor is, and the relationship manager, will be able to guide you better as to what suits you and what is the requirement that you have for your long-term goals. Because based on goals, you'll make investments today, and those investments should be in areas or in funds which suit your risk profile. So these three things, which is where you invest, what is your risk profile, and what are your goals, should be determined first. And I don't think an average Indian who is generally not in the finance field will be able to understand these three together. And hence, it is advisable to have a financial advisor on the fact that are these technical terms? Yes, finance by itself sounds technical to many people. But if we have to make it simple, smart beta is nothing but a selection of stocks based on a given universe, based on a factor. So if you understand the factor, let's say low vol means stable stocks. Momentum means those stocks which have given great returns in the last 6 months or 12 months relative to market, or good returns, or have been the highest return giver. So if we just break it down, then it is not difficult. But yes, it may not be DIY or it may not be do it yourself, because investors have to understand these factors first. And then obviously with the help of an investment advisor or an advisor, they can build their portfolio with these particular funds. And while these sound technical, they're actually not very difficult to understand. If an investor does put their mind to it and tries to understand that these are simple concepts, just that you have to be conversant with them and probably have someone explain them to you and how they fit into your overall portfolio. Thank you.
Okay, so thanks for clarifying this. As you told that the concept of smart beta is not very old in India. So funds are generally 6 or 7 years old. So what should investors check while if they want to consider investing in a smart beta? Is it the return or something else or the expenses?
So as far as expenses are concerned, clearly in India, anyways, the expenses being regulated, plus it is in the interest of investors and the asset management companies that the expenses remain low at a scheme level, which is what all of us are striving towards. So I don't think expense is a major deterrent in terms of selection or a determinant in terms of selection. But what should be the key selection criteria should be what is the factor, what is the universe, and does the factor and the universe fit into your overall requirement? For example, today in India, there is momentum on the top 200 names. There's also momentum on, let's say, mid cap, for example. Now, if mid caps momentum have done too well, and the risk in that can be higher than a normal momentum, and if the investor wants to go for a lower momentum or other lower risk momentum fund, they can choose the uh, one which is suitable for them. Instead of going for the mid cap momentum, they can go towards the top 200 universe momentum. At the same time, if markets are very low and they correct meaningfully, like they had in 2020 March, maybe the mid cap momentum can actually do well compared to the large cap momentum. So it all depends at that point of time what is the selection that needs to be made. And from an investor standpoint, all that they need to look at is what is the universe of stocks from which the fund is going to get selected. Out of that universe of stocks, what is the factors or factor which is going to basically be used to select the stocks, and the most important is the asset management company managing the portfolio of the fund. Is it doing so efficiently? Efficient management of a passive fund or a smart beta fund is basically determined by how close the fund is to the benchmark, and the technical term is tracking error. But to put it simply, how close to the actual underlying benchmark is the fund being run. And it also ensures that your return is not too different from the underlying benchmark index. And that is all given in the fact sheets. So you can have a look at that and choose what suits you, and the factors and the universe and the tracking error, the return differentials, all are available in the fact sheet, including the expense ratios. You can have a look at it and then make a choice. And if you aren't able to comprehend everything, then obviously an investment advisor is always a useful person to be in your life to make you, not just in terms of a smart beta ETF or a selection of a passive fund, but an overall holistic financial planning, which should do well for the long term based on your goals, risk profile, and investments. Thank you.
Okay. And is liquidity also a point to consider in case of a smart beta ETFs?
Yes. So, as far as India is concerned, the markets are just about opening up for passive funds. The large cap passive funds are more or less liquid, but in terms of the smart beta, they being a new concept, liquidity is improving. Can it be better? The answer is yes. And to that extent, all asset management companies, including ours, have market makers, authorized participants who are providing two-way quotes on the exchange, so that if an investor wants to sell, there is a market maker to buy. And if the investor wants to buy, there's a market maker to sell on the exchange itself. So even if there is no natural buying, selling, which may happen at times because the market is less in terms of depth right now, there is a market maker who stays on the exchange. There's a market maker who basically provides two-way quotes on the exchange. They are appointed by the asset management companies, and they ensure that the investor gets enough liquidity on the exchange with the least possible impact as far as execution of smart beta ETFs is concerned.
Okay. And who are these ETFs useful for? Should someone with no market knowledge start mutual fund investment with smart beta ETFs? Or is it advisable for senior people, retirees?
So smart beta ETFs being equity in nature, you have to keep in mind whether your allocations allow you to invest in equity. As I have been saying all the time, and I repeat, equity investments should have a minimum horizon of 5 years. So whether you are starting afresh or you are someone who's about to retire, your investment horizon should be of 5 years. If you need the money within 5 years, then you may have other options like the lower risk balance advantage fund category or some debt substitute or any hybrid which gives you a lower exposure. But since you're investing in smart beta ETFs, which have 100% exposure to equity, you should have minimum 5 years of horizon. If you have 5 years of investment horizon, and whether you are a retiree or a first-time investor, I don't see an issue as far as you investing in the smart beta ETFs are concerned. Just that you'll have to keep in mind which of the smart beta ETFs fits your overall portfolio. What is the objective that you're trying to achieve by investing in these? And more importantly, if you need the money, how you're going to take that money out after 5 years and what is the plan around it. So I think if all these are taken care of, and whether you are a first-time investor or you are a retiree, that really does not matter. You all can invest in smart beta ETFs, but please do give it 5 years. And also, whenever market corrects, you should have the ability to average as well. So that's where the asset allocation comes in handy, wherein you keep always asset allocation in a way that if there is a severe market correction, you are able to average your existing holdings, which ultimately allows you to buy at lower levels. And then when the markets again go up, you're able to participate in the upside while having averaged on the way down, which gives you a better investor experience over a longer period of time.
Thanks for clarifying it. And now my last question is, what are the prospects of a smart beta ETF market, your outlook towards it, and how small investors can benefit by investing in it?
Clearly, in India, all financial instruments have good growth potential because if we look at India as a country itself, our GDP growth from existing $4 trillion to $6 trillion would mean at a savings rate of 15%, which is estimated, we may end up having about $900 billion of savings every year. These $900 billion of savings, some part of it, and maybe a larger part of it, will come into financial savings. And within financial savings, with the new generation warming up to equities, we're seeing already 13 crore demat accounts being created or opened versus just about 3 to 4 crore demat accounts 5 years back. So we are seeing investor interest increasing across financial assets. And with the kind of savings growth that will happen in India, everything will grow in financial markets in India. The only thing is how fast we are able to educate investors about the benefits of investing in equities. And within equities, how mutual funds, be it active and passive, can play a strong role because they are professionally managed. There's a lot of research that goes into mutual funds on the active side. There's a lot of thought that goes into managing the mutual funds on the passive side as well. So if investors choose the right product, even on the passive side, in the smart beta side, I think there is growth in the smart beta, which we've already seen in the last 4 years. Smart beta category has grown tremendously in the last 4 or 5 years. Although as a percentage of overall assets, it's quite small. But we do believe there is growth potential immense across financial assets in general and smart beta products in particular as well.
Thank you. So before choosing the smart beta ETFs, mainly there are three factors. First, look at the universe, and then the factors, and then how close the ETF is performing and how close it is with the benchmark. The discussion has been immensely insightful, and our listeners are sure to benefit from it. Thank you, Mr. Haria, for joining us today and sharing your insight with us.
Thanks a lot to all the listeners as always, and thank you, Outlook, for making this possible. Thank you, Versha.
Thank you. We appreciate your presence. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. With this, our today's episode of Investment Made Easy podcast comes to an end. Listeners, We trust you found our discussion engaging. For further exploration of investment topics, stay tuned to Outlook Money's podcast series, and don't forget to like, share, and subscribe to stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. Stay tuned for our next edition. Until then, stay informed and continue to follow Outlook Money, your go-to personal finance magazine.